When planning for retirement, understanding your income, like Social Security, is important. Just as important is understanding what costs will be coming out of that income. And in today's episode, I'm going to talk about one cost that I find people don't think about or underestimate in their retirement.
Welcome to the Your Life, Your Money podcast with Scott Searens, teaching you how to thrive in life, wealth, and retirement.
Welcome to another episode of The Retirement Show, all about your life, your money, and your taxes. I'm your host, Scott Searens, and my goal is to help you thrive in life, wealth, and retirement. Now, today I want to share a story with you. Actually, it's a story that happens often when meeting with new people. In today's story, we're going to use hypothetical Jim and Sandy. Now, Jim and Sandy come in, Jim and Sandy sit down, and Jim says, I've got a Social Security that's going to be about $3,000 a month, and Sandy says that she's got a Social Security of $2,500 a month. So combined, they look at me and say, hey, we've got a Social Security, total Social Security that's going to be coming in, so we're going to have income coming in of $5,500 a month. Now, and speaking with hypothetical Jim and Sandy here, like I say, it's a story that is very typical of meeting with new people in our office. Jim and Sandy here feel that that's how much money that they'll have coming in each and every month. And I know that if you've listened to this show for a while, is that how much they'll have coming in? And it's not. And why is that? And I know one of the things that you're probably thinking about right away, because we talk about it all the time, is taxes. And you're right, that is one of the reasons why they won't have an exact $5,500 coming in each and every month. But today we're actually going to talk about the other reason, the other item, the other cost in regards to, or what would be reducing their Social Security, or we'll just say reducing their monthly income. And my question is, are you planning for this retirement cost? And that other retirement cost is Medicare and healthcare. And so today's show is all about talking about, are you planning for Medicare? Are you planning for healthcare costs? And we're going to talk about how those costs are going to impact your retirement income. So stick around. We've got a lot of great information about how Medicare and healthcare costs are going to reduce your retirement income in your future. So you want to be prepared for that, because if you feel like your Social Security and your retirement paychecks that you're going to be cutting from your investment portfolio, if that's what you feel that you need, that's what's coming in, well, then you could be in for a shock when you see that the deductions are taken out of your Social Security for Medicare, when you see you've got to pay for the Medicare supplements or the Medicare Advantage. So as you prepare, as you put together how much you'll have coming in, we also want to make sure that you have a great understanding of what could also be going out. Now, before we dive into all of the costs in regards to Medicare, so you're not surprised when it comes to retirement, first off, if you're not receiving our weekly email yet, sign up for our insiders list. You can do this at lifemoneyshow.com. You're going to go to lifemoneyshow.com, scroll down, you'll see where you can sign up for the insiders list. What it is it's our weekly email. It's going to provide you retirement tips, tax reduction strategies, Social Security strategies. What it means is that it's going to help you understand if you're on the right path to retirement. It's going to mean how you can keep more of your hard-earned retirement income and retirement savings in your pocket versus giving it to the IRS and taxes. What it means is that you might be able to help maximize your Social Security. One of our latest wealth reports was the 7 things to know about Social Security before starting your benefits. So again, go to lifemoneyshow.com, scroll down, sign up to be on the insiders list, so that way you can get the wealth report plus many more emails that we send out to help you understand if you're on the right path to retirement. Okay, so back to our story of Jim and Sandy. And let's just say they are both age 65 or older. As I mentioned, Jim and Sandy, Jim said he's got $3,000 a month of Social Security coming in. Sandy says she's got $2,500 a month of Social Security coming in. So their thought process was they'll have $5,500 of income coming in. However, as we already talked about earlier, unfortunately, they won't get to keep all $5,500 a month of income because some will have to go to pay for their retirement health care called Medicare. Now, as I get into the different parts of Medicare, I thought this was a really interesting statistic first from Fidelity. As I had talked earlier, that healthcare costs can make up a big portion of your retirement. It says, according to the Fidelity Retiree Healthcare Cost Estimate, an average retired couple aged 65, and this was in 2022, may need approximately $315,000 saved, that's after-tax money, to cover healthcare expenses in retirement. $315,000 saved to cover healthcare expenses in retirement. Now, part of that $315,000 is going to go towards Medicare. Now, you've probably heard of Medicare, and there's different parts to Medicare. There's Medicare Part A, which is hospital insurance, Medicare Part B, which is the medical insurance. That's your services from your doctors or outpatient care. And then there's Part D, which is drug coverage. Now, some parts have no premium and some parts do have a premium. And so this is the first part as we walk through with Jim and Sandy here in helping them understand that the $5,500 of Social Security that they had planned on won't actually be the actual amount that they'll have coming in to their checking account. Now, let's see what's going to impact that here as we go through these different parts. Well, first off, Part A, the hospital insurance that I talked about, the premium for most people out there on Part A is going to be $0. Okay, so Part A is not going to impact Jim and Sandy. Premium of $0. However, in Part A here, it says the deductible, and I got all of this right from Medicare.gov. The deductible is $1,600, so $1,600 for each time you're admitted to the hospital per benefit period before original Medicare starts to pay. So they might not have a premium here. However, if in retirement, Jim and Sandy need to go to the hospital, right here before any supplements, advantage plans, anything like that, if they didn't do anything like that, they're going to have a $1,600 deductible if they're to go into the hospital. Okay, so right there, maybe some potential cost in their retirement. Now we move on to Part B. Part B, I mentioned, was the medical insurance. This will start to impact Jim and Sandy. So premium for Part B is $164.90 in each month per person. So Jim and Sandy, they've got their Social Security coming in, but deducted from their Social Security will be this Part B premium. They'll each have a deduction for each of them of $164.90 to cover the Part B medical insurance. And that's a standard taken out each and every month. That's the premium that they'll pay for their Part B insurance. Now, on top of that, let's just say they didn't have a supplement or advantage plan. The deductible that they would need to pay would be $226 for any sort of, visit or anything like that. They have a $226 deductible before original Medicare starts to pay. Then for cost of services, it says you'll usually pay 20% of the cost for each Medicare covered service or item after you've paid your deductible. And then we talked about Part D. Part D is drug coverage. Now the premium here will be based on what type of plan you get. If you're getting a supplement plan or if you're getting an advantage plan, that's going to determine what kind of payment that you're paying then for Part D. Premium that you're paying for Part D. So let's just go back to Jim and Sandy here. So Jim and Sandy came in. They thought that they're going to have $5,500 a month in Social Security coming in. However, one of the things that they and a lot of people forget to take into account is that they're going to have at least the base premium for Medicare Part B. $164.90 times two people, that's $329.80 a month. So now Jim and Sandy, their $5,500 a month in income that they thought they were going to have coming in just went down to $5,170.20 a month. Now, maybe if they're healthy, they don't have any prescriptions, no hospital stays, no doctor's appointments, well, then they'll have $5,170.20 coming in each and every month. However, doctor's visits, prescriptions, hospital stays, next thing you know, they need to be saving up for that. As that Fidelity research study said, folks could need approximately $315,000 saved just for healthcare in their retirement. So the first point is what you see from a Social Security standpoint, what the number that you feel might hit your bottom line. You need to factor in Medicare. Now, the other thing here are hypothetical Jim and Sandy. Well, they actually had quite the nice income coming in prior to their retirement. Their adjusted gross income was $200,000 a year. Now, because of that, they then also are going to see IRMAA, the income-related monthly adjustment to their Medicare. What IRMAA is a surcharge that people with incomes above a certain amount must pay in addition to their Medicare Part B and Part D premiums. Now, it's Social Security who determines who pays IRMAA. And they have what's called a 2-year look back. What that means, and I guess I should say, they calculate whether or not you'll pay IRMAA each and every year. And then there's the 2-year look back. So what that means is based on your 2021 income, it's going to determine whether or not you're going to pay IRMAA in 2023. 2022 income, which you probably just filed in regards to your taxes, that's going to determine your 2024 IRMAA. So there's a 2-year look back when it comes to IRMAA. Okay, so we were talking about Jim and Sandy here, and Jim and Sandy had an adjusted gross income, let's just say in 2021, of $200,000. Well, if you go to Google, type in IRMAA, IRMAA, ask for an IRMAA table, and you'll find exactly this. And what it shows is that there's a table, and based on how much you make, then you might pay extra or more, right? That's the surcharge that you'll pay when it comes to Part B and Part D premiums. So, for instance, a married couple filing jointly, $200,000 of adjusted gross income, their Part B premium goes from $164.90 a month to $230.80 a month per each person. And let me just kind of walk you through the tiers here. It goes $164.90. The next tier is $230.80. Tier after that is $329.70. Goes then to $428.60. $527.50, all the way up to, if you have $403,000 of income and above, it could be up to $560.60 per each person for Medicare Part B. So, as I had mentioned, Jim and Sandy here, they fell into the level of $200,000. So what does that mean? Well, their Part B premiums went up to $230.80 per person. Now their $5,500 a month of income actually just got reduced from what we said before down to $5,038.40. Now, what you might be thinking is, well, if I retire then and I had some really good income before retirement, oh, thank gosh, IRMAA will go away in retirement. And that could be true, but let me tell you, the IRMAA surcharge could actually come back, and it could come back towards those later years of your retirement, and let me explain why. It's that word or that phrase called required minimum distributions, your RMDs, as that adds into your AGI, your adjusted gross income. Let me just give you an example here. Let's say you have $2.5 million in your IRA at age 85. The required minimum distribution that you're going to need to take is $156,250. Let's just then add that into your pension, add that into your Social Security. Next thing you know, you might have over $200,000 of adjusted gross income in your retirement. And so you think that you got away from IRMAA, but next thing you know, in your 80s and your 90s, you're paying that surcharge again on your Medicare premiums. So That's something that we'll talk about in the end, is how to plan for that and how to potentially reduce that in your future. So now as we continue to go through our story here today, Jim and Sandy, we've just focused on what I've called base Medicare. But as I mentioned, there's some different deductibles and copays, and maybe Jim and Sandy want to get a supplement plan or an advantage plan to help them in regards to those deductibles and those copays. And we're not going to get into today the cost of that, because that's going to vary by where you live, by which type of plan you get. But just know they're $5,500 a month in Social Security, which is now down because of IRMAA to around $5,000 a month. Depending on if they pick a supplement plan or an advantage plan, it could stay the same. It could stay right at around $5,000 a month, but it could also become $4,800 a month or $4,700 a month or $4,600 a month, depending on what type of plan that they go with. So again, have to think about what you think you might have coming in from Social Security can get reduced by Medicare. Then the next part is not just what do those costs look like today, but then what will those costs potentially look like in the future? And I've got a list here from, not a list, but I got a chart here from healthsystemtracker.org. And a little bit of statistics. Now, it said using the CPI, overall prices grew by 6% in February 2023 from the previous year, while prices for medical care increased by only 2.3%. So my next factor here that you really need to think about is inflation. If you're building your plan, are you putting inflation on the Medicare cost? Are you putting inflation on your health care costs? Now, I know it just said 2.3% over the prior year, but they actually had a really good chart in here that went all the way back to the year of 2000, and the cumulative percentage change in consumer prices for medical care from 2000 to 2023 was 115.1%. 115.1%. If we divide that over 23 years, next thing you know is you're looking at a 5% per year increase in medical care costs. So when you're thinking about your medical care, when you're thinking about your health care, when you're building your income plan and you're factoring now that we know we're factoring in base Medicare, we're factoring in Medicare supplements, are you factoring in inflation on those costs as well? And so you have to think about those costs going up. So it's important that you think about what will happen to your future income if those costs were to go up. Now, let me just walk you through some different thoughts and things that we're going to help Jim and Sandy think about and plan for when they come in and they sit down and they want to put together their plan. So they originally thought, okay, here's my Social Security. I'm going to have $5,500 a month coming in. And as we already mentioned, we know that taxes will potentially have an impact on how much they'll have coming in. But today's focus was the medical cost, Medicare. So one of the things that we're going to factor in to their future income plan is we want to factor in Medicare. And as you're putting together your income plan, are you factoring in Medicare? The next thing is, are you factoring in additional cost for Medicare supplements or Medicare Advantage? Are you factoring in additional cost for prescriptions, for deductibles? Are you thinking about what those costs could potentially be each and every year in your plan? Then after you factor in those costs, are you adding inflation to those costs? Because you not only need to understand what your income will be today, but what would your income be in 5 years from now, 10 years from now, 20 years from now? Then, dependent on your income, are you factoring in IRMAA? Are you going to have any surcharges where your base Medicare premiums could potentially be higher than the actual base premium? Are you factoring in any of the surcharges? Are you looking then at your future years based on how much you have saved up in your IRAs, 401ks, 403bs? If you have a healthy amount saved up, plus you have a good healthy pension and you've got Social Security, and you might not even need the pension, you just, based on how much you have saved up in your Social Security, would you potentially be looking at IRMAA in your future years, in your 80s, in your 90s. Now, one of the things that we do to help people reduce IRMAA in their future years is we look to see if they should be doing Roth conversions once they retire. Now, of course, when it comes to Roth conversions, you hear me say this all the time, it's something that you want to talk to your tax professional as well as your financial professional about. But there are ways to take some of that IRA, 401k, 403b, the money that's going to lead to RMDs in the future, and instead pay tax on it today, put it in the Roth bucket where it's going to grow tax-free, and you could potentially have tax-free withdrawals as well. So there are a lot of things to think about here, and it's important that you plan for these costs when it comes to preparing for retirement so you can set proper expectations for yourself of how much retirement income you'll have coming in. And then that way you don't have any surprises when it comes to your retirement. Hey, I hope that you found today's episode to be of value and benefit. I'm sure now your mind is definitely thinking, okay, I saw my Social Security statement, but that's not what's going to be coming in. I'm going to have to factor in Medicare. I'm going to have to factor in maybe Medicare supplements, Medicare Advantage, deductibles, etc. And I hope that it's helping you set proper expectations for yourself, your retirement, and your future. If so, you found it to be of value and benefit, you want to hear additional episodes to help you and your retirement, subscribe on your favorite podcast player. Also, don't forget, if you haven't yet, you're not getting our weekly email, then make sure you sign up for our insiders list. You can sign up at lifemoneyshow.com. It's our weekly email that's going to provide you with retirement tips, tax reduction strategies, Social Security strategies, Medicare thoughts and strategies, and much, much more. It's going to help you understand if you're on the right path to retirement, help you understand how to maximize your Social Security benefits, how to minimize the taxes that you'll pay to the IRS. Our latest wealth report that was sent out in the weekly emails was 7 things to know about Social Security before you start taking benefits. So again, you can go to lifemoneyshow.com, scroll down, sign up for the insiders list, so that way you're getting our weekly email. Hey, I look forward to our next conversation to helping you enjoy life today and being financially confident about your retirement.
Insurance products are offered through the insurance business Sierens Financial Management, Inc. Sierens Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Sierens Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, and higher taxes on Social Security benefits and higher Medicare premiums. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.